Here we break down the previously seen high yielding trading strategy. The link for the video from which these strategies were generated is given here. We are looking at the same results as before, but this time in column D you can see we have added the long to short SMA ratio column. This simply divides the long SMA period by the short SMA period. So the smaller the short SMA is relative to the long SMA, the higher this value will be. The highest values are shown in green and the lowest in red and amber in the middle. From the graph we can see the 4 spikes. These correspond to the strategies with the biggest differences between the long and short SMAs. This graph just takes into account the 50 highest yielding trading strategies, the vast majority of which consist of low ratio strategies. For example, on row 9 we can see the short SMA is 135 and the long SMA is 315. The relative difference between these two values is quite low when compared to, for example, the strategy seen in row 3, with 10 being the short SMA and 3 to 5 being the long SMA, giving a very high ratio of 32.5. The point is that many of the top 50 performing strategies seem to have short moving averages that are relatively closer in value. In this video we try to understand which kind of strategy might be better to use. Here we can see the daily chart for the pound dollar. For this example, I have used a short SMA with a period of 9 and a long SMA with a period of 70. The 2 blue circles show regions where there could be a substantial number of crossovers between the 2 SMA values. This phenomenon was highlighted in previous videos when one SMA is very short and the other one is very long. Then when price is less directional, there can be a higher number of trades opened and closed in quick succession. This is a potential danger of using a strategy with a high long to short SMA ratio, but it could also be its advantage. In this scenario, the losses incurred by these more frequently opened and closed trades are relatively small. This can be seen here visually because when a trade is closed shortly after it has opened, it has not moved enough to induce a large loss. Of course, if this kind of thing happens far too frequently, then this may result in a less than successful strategy. If we look to the left of the blue circle on the left, then we can see prior to this a trade would have opened, which was a long trade in July, and this would have run all the way until mid-September and would have locked in a profit. Again, another long trade has opened from November and closes the following April. This would also have resulted in a very profitable trade. This screenshot shows a further period in which the strategy would have performed successfully. A short trade is opened on the left and then closed. A long trade would then open and close shortly afterward, resulting in a small loss. However, in November, a short trade is opened and this goes right up until January, where it is closed, at which point another trade, a long trade, is opened, which goes to early March and results in a small loss, at which point a short trade is opened and goes all the way to June and probably past, which would result in significant profit. We can see from here, as the currency pair becomes more directional, strategy does work well. We see from this screenshot that the prior trade that opened in March runs all the way to early November. Short trade has made a huge move, and although price begins to retreat, the trade closes in early November and the long trade is subsequently opened, which ends in mid-February. This would no doubt result in 2 highly profitable trades using this strategy. In early February a short trade is opened and this goes to mid-March, but as you can see this causes virtually no loss. Just before April another long trade opens and continues into July 2023, and it is likely that this would result in profit, as the short SMA, when this crosses below the red line, the trade would obviously exit, and this will occur before the price drops below the opening point of the trade. Here we jump back to 2019. By looking at the period up until September 2019, it is obvious that the short trade that would have opened would have locked in a huge profit when it closed in mid-September, after which a long trade opens and then closes just before November with little loss. The period from mid-September to mid-November results in one of these high chop periods when the currency pair is range bound, but as ever the losses seem to be small and could be mitigated by the times when the trading strategy is more directional. From early November up until January a short trade opens, the price then swings back to lock in a small profit. From mid-January to mid-April a long trade opens, which is once again a profitable trade, after which a short trade is instigated, and this is also likely to lock in profit. I have been showing higher time frame strategies, as even if these strategies are implemented manually, there is still enough time to occasionally monitor these and execute them properly. There are also lower slippage implications and commissions. The aim of this video was to try to emphasize the point that strategies with the higher long to short SMA ratio, even though far less frequent in the top 50 performing strategies, could be the way to go, because they are not idealized to the rhythm and flow of any particular currency pair. The strategies whose SMA values are relatively closer together could be more problematic when moving out of sample or to different currency pairs, because these could be showing up as profitable in our back tests, as their volatilities may be synchronous with the way the currency moves, but further testing will be done to ascertain this. Once again, please like, comment and subscribe, and let me know if anything is not clear or what other strategies you may want to have tested.